Hello and welcome to this episode of Mic'd Up with iCM. My name's Pete Seyler, a member of our business development team here at iCM. And today I'm joined by Chris Peel, portfolio manager with Franklin Templeton. Chris, thank you for joining us.
Thanks, Pete.
Would you mind taking a moment, briefly introduce yourself to the audience and explain your role at Templeton?
Sure. Yes, thank you for the time. I've been at Templeton for the past 16 years, both in the capacity as a research analyst and a portfolio manager. On the research side, I've covered a lot of sectors over the years, such as commercial services, energy, software, oil services, and countries like the UK and Ireland. And I currently head up the global energy research team within the Global Equity Group. On the PM side, I am the lead portfolio manager on the Templeton Foreign Fund and have been in that role since July 2019. And as you can probably guess, Foreign Fund is an international fund. It means 80% of those assets are invested outside of the US. We are long-term, patient, contrarian, bottom-up fundamental investors. Our turnover is relatively low, between 20 and 25% a year, depending on the volatility. And what we really aim to do is take advantage of that volatility and at market turning points to buy stocks for the long term. And following the same time-tested process that Sir John put in place more than 50 years ago. So I'm a passionate investor. I love what I do. We've been very pleased with the performance. So we've seen a pretty decent turnaround since taking over the fund, and we're pretty significantly ahead of the index over the last 3 years or so. So very pleased with that.
Great information. I love to hear the passion. And with passion in mind, is there really anything that stands out to you right now within international markets that you feel is really a unique opportunity?
Thanks, but I do think it is an incredible time, or incredibly interesting time to be in international markets. I would say it's really hard to pinpoint just one unique opportunity, but there's a few things that I would highlight. Think first of all, the asset class in general is a good diversifier today to complement exposure to US markets, where we've seen a lot of the US growth stocks drive significant performance this year. I mean, if we put that into numbers, 7 largest stocks in the S&P 500 have contributed over 70% of the return so far this year for that index, and they now account for almost 30% of the index weighting. And with a number of those stocks, they're up 50 to 200% in some cases. So just having exposure to the S&P 500 leaves you significantly exposed to the fortunes of these 7 stocks, which, in our opinion, despite being great companies, don't look undervalued. If anything, they look slightly expensive to us. And look, international markets can really help diversify away from some of that exposure. I think second, valuation, near and dear to our hearts here at Templeton. The spread between US and international markets, although international for the most part has traded at a discount to the US over the long term, that spread has grown significantly over the last few years. If you look at ACWI ex-US, trades at around 13 times price to earnings relative to the US at over 20 times, and that's a 30-year low today, a 35% discount to the S&P 500 on a number of metrics. So it used to be around 10 to 15%, so that spread has widened, making valuations attractive. I think finally would be the dollar. Although not as strong as it was at the back end of 2022, the dollar does remain at a premium to many international currencies, such as the yen and the euro, certainly when looking at purchasing power parity, meaning you can take your strong dollar and use it to buy cheap international businesses where you potentially get that added tailwind of the currency return on top if the dollar weakens. So really interesting time, Pete, to be allocating to international markets, certainly relative to the US today.
Chris, great information. Really appreciate it. It's music to our ears and why we like you guys. But let's transition just a little bit. And as of today, is there anything that concerns you within international developed markets?
Yeah, I would say probably a couple of things. I mean, first and foremost, rates. And again, this is probably not just for international markets, but it applies to most of the world. I think that the impact of rising rates has started to make its way through economies, but really hasn't seen the full impact and should start to bite as we move forward. I mean, we've seen evidence in some sectors such as housing, etc., but there is a lag effect here, and we really haven't seen the worst of interest rates really impacting the consumer. I think offsetting this, though, is obviously the attractive valuation, so that we've got to think about the starting point there. I'd say probably the second thing that we're always thinking about in international markets is geopolitics, whether it's the conflict still ongoing in Ukraine or the souring relationship between US and China. They're always certainly something that we're thinking about when we're investing overseas. So those would probably be the two I'd highlight at the moment that we've got our minds focused on.
Great, thanks. So, we're going to transition here for, our last question of the day, but it's a three-part question, and it's the, some of the proverbial crystal ball. But, what are your short-term, intermediate-term, and long-term outlooks for international markets?
Okay, splitting it up, I guess. I think, if we think about the short term, it's always very difficult to know. It's always very hard to predict markets in the short term, and that's certainly kind of how we think about them in our work. And we often do come back to valuations and use that to drive our thoughts and views over the long term. So in the short term, I'd probably point back to we're cautious that rates still need to bite, still need to impact the markets. We've seen international markets have a very strong recovery from the depths of over a year ago in September last year, where we had the European energy crisis that was impacting markets, and we've seen a very strong reversal in the performance of a lot of those companies, and we've benefited from that. And then I think finally, we are finding less bargain opportunities today versus where we were last year. So slightly cautious in the short term. But that said, given where those valuations are, certainly relative to the US, and still on an absolutely low basis, for the long term, we are optimistic. And we believe that international developed markets can offer good returns relative to potentially to the US market. I think one thing that always gives me confidence, again, for the long term is regardless of the cycle, given the large and diverse nature of those international markets, there are always areas of the markets that are on sale where we can find opportunities. So certainly for us as bottom-up fundamental stock pickers, we remain confident in our ability to be able to find those opportunities and put them into the fund.
Great. Chris, I can't thank you enough for joining me today. Truly appreciate it. Thank you.
Thanks for the time, Pete. Really appreciate it. Thanks for having me.
Absolutely. And as always, if you've enjoyed this video and have additional questions or would like to request a topic for Mic'd Up, please do reach out to us at 888-426-4689 or via email at info@icm-invest.com. Thanks for watching.